Today, crypto markets struggle to break a 4-day losing streak. Tether takes steps to make its stablecoin more transparent. And a new study says up to 25% of Coinbase listings show signs of insider trading. Welcome to CNBC's Crypto World. I'm Pippa Stevens. Digital currencies are mixed this morning after 4 straight days of losses. By noon Eastern, Bitcoin traded around $23,000, Ether rose to more than $1,800, and XRP dipped to 38 cents. All right, on to the top stories. First up, crypto investors are still keeping a close eye on the global economy. Inflation is surging in the UK, hitting 10.1% thanks to rising food and energy costs. What's worse, experts think rising costs won't peak until the fall. That could drive the Bank of England to pick up the pace of its interest rate hikes. And here in the US, the Federal Reserve just hinted that it's going to keep raising rates despite data showing inflation could be cooling slightly here in the States. Investors feared too many rate increases could push the U.S. into recession, which would spell bad news for risky assets like crypto. Next, Tether is taking steps to make its stablecoin more transparent by working with a new accounting firm. The USDT issuer will use BDO Italia, which will publish monthly reports on the state of Tether's $67 billion in reserves. The decision comes after months of promises from the issuer to be more transparent about its reserves. It also follows regulators and lawmakers around the globe placing new scrutiny on the stablecoin industry after the collapse of Terra USD. Finally, a new study says crypto insider trading may be a bigger issue than previously thought. The research out of the University of Technology, Sydney, found that between 10 and 25% of crypto listings on Coinbase showed apparent evidence of systemic insider trading. The study looked at 146 tokens and their price moves on decentralized exchanges 300 hours before Coinbase announced their listing. The study found a run-up in token prices around 250 hours before the announcement. A spokesperson for Coinbase told CNBC, quote, "Coinbase takes allegations of front-running incredibly seriously, and we work hard to ensure all market participants have access to the same information. As part of this effort, we take steps to minimize the possibility of technical signals during asset testing and integration steps. We have zero tolerance for illicit behavior and monitor for it, conducting investigations where appropriate." Coinbase is currently facing a probe by the Securities and Exchange Commission over its listing process. Well, speaking of insider trading, for our main story of the day, Crypto World's Jordan Smith spoke to David Maria of Bittrex about these risks and what tools regulators have to fight it.
First, how real is this insider trading issue broadly in crypto markets? This study looks at Coinbase, but previous studies have found similar evidence on Binance as well. How big of a problem is this?
You see from the current news that it's a problem. It's something that's out there. It's something that hasn't really been policed until recently. The bigger problem is where you can accomplish this. So it's the decentralized exchanges that they don't perform KYC. You don't know with whom you're transacting. And frankly, it's hard for the government to get anything because they're decentralized without really going to the blockchain and mining the data that way. But as you've seen, there are, with large exchanges, if they're going to list a token, it can move the markets. So that is material inside information that can lead to an advantage to someone trading with an unknowing counterparty.
So that's actually my follow-up question to you. Is this an issue with decentralized exchanges specifically, and could something like KYC solve that?
I think it helps. It can't solve it, right? So if someone wanted to, if they had material information about a token, if it was going to get listed on one exchange, they could theoretically go to another actual exchange, create an account there, or if they already have one, they could trade if it's already listed there. I mean, that's the factor they need is it already has to be listed somewhere else. If it happens, they could do the same thing. If they wanted to start a new account, trade. The thing there is it's a lot easier for law enforcement to get that information. So law enforcement can drop a subpoena on that exchange, get all the trading records, get everything they need, and it's right there. Whereas on the decentralized side, it's a lot harder to go and dig into the blockchain to find out where the wallets are, and then make those connections between the people who may be doing the trading in these wallets. So it's less likely to happen, but I'm sure it also does happen on centralized exchanges.
In regards to evidence, this study looks specifically at wallets trading 300 hours. before a cryptocurrency is listed on Coinbase. Is looking at wallets enough to prove insider trading, or would a prosecutor need some sort of proof of material non-public information?
You would need both. I mean, the wallets will give you the trading activity, but there'd be no evidence that you did anything improper. Just timing it before a release on a certain exchange, a prosecutor or an SEC enforcement lawyer could try to make the connection and try to say to a jury or a judge that that's enough, but very unlikely that would succeed. And frankly, from a criminal insider trading standpoint, it's almost nil chance that a prosecutor would try to bring a case like that without having more about the knowledge of the individual.
How does this compare to possible insider trading within stock markets?
I think it lags behind in terms of the technology that they use now. I mean, obviously, the exchanges, NASDAQ, New York Stock Exchange, and the SEC, they have algorithms that they run where they can see who's trading in advance of an announcement, who's trading in advance of something that's material and non-public, and then the tools would be the same once they have that data to go try to get the remainder of the evidence regarding knowledge, by subpoenaing entities, phone records, things like that, email accounts, and going directly to the companies where they work, where they may have obtained that info. And they look on that side. The SEC also looks at like clusters. Where is this happening? Is it in a certain geographic area? Would that person or would that area have a reason to have the data? So they have a pretty sophisticated means of trying to figure out if someone is trading on material non-public information, or if it's just maybe lucky on their part that they traded in advance of something that was beneficial.
Yeah, and obviously traditional markets are pretty heavily regulated, but there's a lack of regulation on crypto in the US. So what tools do regulators or prosecutors have to bring insider trading cases about? I mean, is this another sign that regulation by enforcement is coming for these types of cases?
Well, first of all, I'd say that there certainly is not a lack of regulation in the U.S. with regard to crypto exchanges. I mean, we and all other exchanges that operate here are highly regulated, probably more so than a lot of others, because until the regulation's sorted out, we're regulated by the states where we do business. We're regulated by, obviously, Department of Justice has oversight over everything. The SEC tries to regulate. Arguably regulating by enforcement more than by giving guidance, and the CFTC as well as Treasury, both FinCEN and OFAC. So the oversight is there and it's substantial. On the decentralized side, that may be where, as we discussed before, it's a little harder for them to go get the data without using very sophisticated means. There are two prongs, right? So there wasn't just the SEC's enforcement action against the Coinbase employees. There was also a DOJ indictment. And one thing that's telling is that the Department of Justice's indictment of those individuals didn't bring them as securities fraud actions, right? So they brought them under the wire fraud statute. What's telling about that is that doesn't require them to prove that any of these tokens are securities. And that's a hurdle the SEC is going to have to overcome in their action. And they listed 9 of them out of the 25 or so that were transacted and put forth their analysis as to why those are security. So that's an element that for the first time they're really tackling head on in that one. So it's interesting for the industry generally. It's interesting for anyone who works at these exchanges to digest that. And I think that's a very new development here, obviously, and there may or may not be more of those, but it does show that they're looking at these things. And from the SEC's complaint, you see they did a relatively detailed review technically of the blockchain trading on this to find these wallets apart from the centralized exchanges.
Okay, that is all for today, but we are back again tomorrow and we'll see you then.